You're in the Business Insurance Zone with me, Steve CVAT, national insurance columnist and financial color commentator. This week on The Biz, the Life Insurance Income Series, our tribute to Life Insurance Awareness Month. And on today's show, illustrating the plan design.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome to the Business Insurance Zone. I'm Steve CVAT, your host, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And my co-host all this week, Eric Palmer. Eric, we've been talking about Life Insurance Income Series all this week in tribute to, of course, Life Insurance Awareness Month.
Right.
And we're trying to make you aware of something that you know, which is life insurance for supplemental income.
Right.
Unbelievable.
Right. Well, you know, as I said before in the last show, we've been promoting Life Insurance Awareness Month, and a lot of times all we see is indemnity promotion. You know, legacy transfers, wealth transfers,
Right.
life insurance as an indemnity sale. But the reality is today, there's a huge movement towards life insurance as a supplemental income source, and if you haven't gotten into this yet, you need to get into this side of the business, because let me tell you, the wave is coming, and more individuals are starting to look at life insurance like they did way back in the Great Depression era as being a really foundation of their retirement plan. So it's not going to be the end all, the ultimate one source, but it's definitely going to be a big part of the supplemental retirement scheme.
If this is done right, this can be a major component, a major player. Maybe not or like you said, it's not everything. And remember, there are 401ks. Sometimes when you have superior matches, dollar for dollar by your employer, that's a good thing.
Right.
Okay. And I don't want to take away from that at all. Just we're going to have to do the math and see if it still works out. And by the time we get to Friday's show on the tax issues, we'll see if the math works out, because I'm not always convinced.
Right.
Now, today we're talking about the basic idea of illustrating a plan design. Now, for you who've been around for a long time and doing this, you'll say, hey, Steve, I already know this, but I'm telling you, everything that comes across my desk is completely wrong if you're doing it for income. And this is why I want to just stress this. Now, when we're talking about this, we always talk about this MEC rule. Everybody's been, what's a MEC?
Right.
Every time we get consumers that watch our show, Steve, what the heck is a MEC, right? And so I always say, oh, I'm so sorry to bring this up. There's a little law called TAMRA that was instituted 6/21/1988. And that changed the way we can fund insurance or make contributions based on the death benefit. Our job is always to keep, as we said yesterday's show, yesterday we talked about it. If you missed how to place or position the right insured on these chassis for retirement income, you need to go back out to brokersalliance.com. As soon as you're at our homepage, hit the red on-demand button and listen to that show, then watch this show.
Right.
Now, when we talk about this, minimum death benefit, because that's our goal, but minimum TAMRA compliant death benefit, not just any old death benefit. I got to get it down there as low as I can and still be compliant with the old law. So that's the first thing I want to talk about.
Well, first you mentioned the MEC, the modified endowment. We got to make sure that we're not MECing these contracts, because then we've lost the big component here, which is the tax-free loan capabilities within the contract. Now, a MEC contract still has a tax-free death benefit, but as we've said all this week, is when you're talking about supplemental income, it's our belief, and I think a lot of people share this, that we're taking the indemnity sale out of the scenario. We're focusing on income. So we don't want to MEC the contract, because we like the fact that we have tax-free death benefit, but we have to have those tax-free distributions via loans. Otherwise, we've kind of lost the whole point here. So you want to keep it within that structure. And then, of course, the minimum death benefit solve. A lot of the carriers have built this into their software now, where you can click a button and tell it to solve for the minimum death benefit. But there's some tricks there that you have to keep in mind. It doesn't always solve for the absolute minimum death benefit. Sometimes there's some room there to breathe, and that can squeeze out some more dollars of income. So one of the things that we do here in our illustration marketers that are here at Brokers Alliance are trained to do this. We don't just take the software's word for it. We go back in and we want to squeeze that thing down a little bit more, or possibly look at bringing death benefit down when we start taking that income. So don't just rely on the quick, easy buttons that are in the software. There's more to it than meets the eye.
Oh, Eric, yes. We're talking about customized. I never listen to Home Office. I don't care what their illustrations are. I always want to do this by hand to make sure I'm at the floor. Once I've established I'm at the floor of the minimum non-MEC death benefit, once I do, then my question is which one works better? Option A, level death benefit, or option B, increasing. And I'm just using that as, it's pretty much standard nomenclature. There's a few carriers that still aren't doing this right, but pretty much level or death benefit. Now remember, I have to do them both sometimes. the shorter the pay because I'm not really sure which one will work. And every carrier, unfortunately, there's no standardization. Every carrier has little corridors that they allow, and sometimes, shockingly, even I was shocked at this, I could use an increasing and move to level early on a 5-pay. I didn't think that was going to work. But remember, there are anomalies. But what I like to do is I like to do them both to see which one's going to deliver the lowest cost of insurance. So buying the minimum and choosing the right option. And you brought up a point, and I want you to talk about it. You said, oh, we're going to drop it again before distribution?
Right.
Talk about that.
Well, you make a great point about option B and option A too as well. Remember that they both carry two different cost structures in the contract. So option A and option B are not priced the same. So you've got to look at them both. You don't just always assume that increasing out the gate is going to work every single time, especially when the payments are different. And also, it's dropping that death benefit. So we might start out with an increasing death benefit, and somewhere towards the point, maybe 1 year or 2 years before we stop funding, or right before we're going to take the income, we might want to go to level death benefit because it changes that cost of insurance structure. It squeezes it down a little bit more, gives us more bang for our buck. And also, very important fact here is don't ever forget, even though we start taking income, say at age 65, we're still relying on the rate of return inside the policy minus those costs and expenses to provide the ongoing ability to continue to take income. We don't want the policy to lapse. We want to maybe hopefully provide our client with a levelized income scenario. And so by dropping that death benefit down, we're also kind of controlling some of those costs on the ongoing rate of return and potentially putting more interest into the cash value after you started taking income. So those are really important components because if you're controlling the costs in the contract and you're squeezing it as much as you can, you're going to get more income.
That's the goal. So when we not only buy the front end, lowest non-mec'd out death benefit, but at the point of distribution, I'm going to try to lower the death benefit again if the computer will allow it, and switch the options out if it's necessary to keep driving the cost down and keeping the corridor so tight that the internal rate of return on these policies just power you through the illustration. When we come back from the break, we'll address the distribution strategies frequently used in life insurance retirement plans. And don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Everyone's looking forward to retirement, but how do you get there from here? You do it by paying yourself first every month and saving with Index Universal Life. And once you're there, how long is your retirement? With Index Universal Life, it can last a lifetime. How much can you keep? It lets you keep all of it. And what if you need it sooner than later? There's no penalty for early withdrawals, and you have the flexibility that you need. How to get started? Go out to www.iflplan.com and find out more and start looking forward for retirement. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And remember, you can order today's giveaways at brokersalliance.com. And just a heads up, before moving forward with any of the ideas you hear on the show, always consult your tax advisor and broker-dealer compliance officer. We're talking about distribution strategies that are frequently used in insurance retirement plans. And believe you me, until indexing, it was pretty straight up. Withdrawals to basis, policy loans to gain, make sure the withdrawals to basis happen most of the time after the 15th year to avoid the force out rule. There's a lot of issues there.
Right.
But now we're into a huge arena here. And we're gonna really manage this in next week's show when we really get into this. But when we're talking about income, our goal is, of course, tax-free income, whether it's withdrawals to basis, policy loans to gain, or whatever. Now, I want to bring up something that Eric and I don't know of anybody out on the street that's talking the way we're talking about it because we want to make sure we cover it. And that is, once we went to participating loans where if the actual market actually performed greater than the cost of the loan, we actually got paid not only our distribution, but we got paid to loan ourselves our own money.
Right.
I love that.
Right.
But here's the problem. In 2001, 2002, 2003, and 2008, 4 of the last 10 years, we had loser years in the S&P.
Right.
And if you were paying 5% fixed or a variable, even if it was a little lower than that, you actually had to pay your loan costs. You actually also had to pay the expense of the policy. And even at the lowest one that I saw today, you're still paying somewhere around 550 to 600 basis points to take your own money out. You're going to need withdrawals to basis to try to mitigate those bad boy years if you're using participating
Well,
loans?
you know, we always talk about flexibility in index universal life or life insurance policies in general. That's one of the big sales, tools that we use, is that you have all this flexibility. Don't forget, you don't lock your client into any one loan strategy. Every single year, they could take a different loan type. They can go fixed, they can go variable, or they can go withdrawal to basis. So you call them bad boy years, the year that you get a zero. Don't put yourself in a negative arbitrage.
Right.
Look at a withdrawal to basis. The big issue is going to be who's going to be there to help your client do that. And that's something we can talk about in another show. Some of our insurance companies, though, have priced into their products the service teams that are going to be available when your clients get down the road to help them make these decisions. But you don't lock it in. I think the flexibility aspects are huge. So you can choose the variable loan or that fixed loan or that withdrawal to basis, and educating your client up front about the flexibility. You don't have to tell them what to do, or you don't have to get into extreme detail about the mechanics of withdrawals to basis and taxes, because you'll probably lose them. But let them know that they have choices, they have options, and you're not locking them into any one thing. So when the time comes for you to take income, we can make the right decision every single year.
And because it's so flexible, this is why I love this product, and there's so much out there, I just want to make sure our producers know, heads up, there are so many different ways to skin a cat here on this, and there's two schools of thought. Some that use participating loans, and then I'm going to use withdrawals to basis. Remember, you can use those in about maybe 5 or 6 years of non-crediting years, then you'll be out of basis.
Right.
Then you will be stuck. But some people also don't use participating loans. They're more conservative, and they like to see the traditional withdrawals to basis and policy loans again. If you're one of those people as a producer and you're just uncomfortable for whatever reason, remember, we do it all. You can use zero net cost loans. By the way, think about that, zero net.
Right.
The charge and crediting is like 31 days apart.
Right.
So it's the same rate. You could use wash loans.
Right.
You could use spread loans. And if you're a whole life purveyor, because we have people that sell whole life for income, you could use regular spread loans or direct recognition loans, which I'm not really a big fan of, to be honest with you. But those are the loan provisions. Now, Eric, let's talk about this. We talked about yesterday about the maturity date. If somehow, some way, this is done wrong or illustrated wrong, which we see a lot,
Right.
what would happen if I have these loans online and my maturity date, I live past my maturity date, or for whatever reason, I took too much out? What would happen to my income that I took out on loans?
Well, the biggest thing is that cumulative total income then becomes exposed to taxation. So let's say you're in an ordinary income tax of 25%, small number, right?
Right.
I think I'm being a little bit modest there, but 25%, and I've got an outstanding $100,000 of loans, my policy lapses, or my policy matures. Now I'm exposed to ordinary income tax on that $100,000, and so you talk about designing them right. We see it all the time. There's different schools of thought on how to design life insurance policies. But if you're not protecting yourself against the possibility that this policy could run out, you could, or if it's underfunded, if the client's not on board to put the number in that you're showing them, but they're going to take the number out that you're telling them in terms of loans, they're going to be in trouble. And let me tell you, I hope you better have your E&O coverage really up to date at that point, because if you expose your client to several $100,000 of ordinary income tax all at once, you're facing a lot of problems.
There are serious problems. And by the way, a little side note, remember, 99.9% of all clients never pay the prevailing annual interest rate due on these policies. That means that the inside cash values are being cannibalized, not only to pay my normal distribution, but now I have to pay my interest. And if I'm letting it ride, those numbers get big. So if I had a lapse policy, or I got past the maturity date, which I still think is a huge issue, you would not only have an ordinary income tax on what Eric just said, but you'd have a phantom ordinary income tax on all the money in the policy which you never took constructive receipt of.
Right.
See, that to me, that's why it's so important to do this right, and that's why what we've done is we've really went out of our way to manage this issue all this week, because we want to, this is a huge boom for the retirement market. We get to Friday's show and we talk about the tax advantages of doing what we're talking about.
Right.
They're huge, but if I can't make this right, then I'm just blowing all that. That's why it's so important to do that.
Right, absolutely. I think at the end of the day, too, don't always worry about solving for and squeezing the absolute highest number out you can, because if you are making comparisons to traditional plans, you don't have to have the most to still defeat that traditional plan. So don't worry about squeezing every last dollar out in every single situation.
Yeah, we'll do that for you.
Right.
And remember, you can watch this show and all our shows by clicking the red on-demand video button right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. Get in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.